So I want to talk about some of the macro geopolitical concerns, considerations that are out there today. I'm going to talk about some of the different issues, globally that we're looking at. And let's start with the trade war in China. So, 2019 felt a lot like this at times. You had investors and you had a ton of different headlines, some good, some bad. And you saw a lot of the headlines kind of driving, short-term investor moves when it came to the trade war with China. Why was that so important last year? Well, you go back 20 years, so you look at the different countries in blue, that's the U.S. as the largest supplier of goods and services to those countries. You look at the countries in red, that's China being the largest supplier of goods and services. And 20 years ago, the U.S. had a stronghold on a lot of these different countries. You look at today, that change is pretty dramatic, right? Outside of really North America, China is the largest supplier of goods and services almost across the world. And they've made huge strides in these areas. And it goes back to why, when you looked at how the market was reacting to some of the trade news, why it was such a big deal. Let's look at the last 35 years of our trade, U.S. trade with China, and how that's changed. You go back 35 years ago in the mid-'80s, it was almost non-existent, right? There was not much trade going on between us and China. You go to today, we're importing over $400 billion worth of goods from China. We're exporting, before the trade war, over $100 billion worth of goods and services. We're at a trade deficit there, not as big of a deal, but you can see that impact of having, upwards of over $500 billion worth of trade between the U.S. and China, the two largest economies in the world. And this is pretty fascinating. So if you go back over the last 30 years, this chart shows just how global growth has been. The first 20 years, going back to about 1990, global growth, year-over-year change was over 5%. The last 10 years, not as strong, a little under 5%, but that's not the big thing to focus on. Really what I want to focus on is the contraction. Now, we've only had 2 years worth of trade contraction in the last 30 years. One being in 2009, following on the heels of the Great Recession. The other being last year. So, for a while when we didn't see as much of an impact because of, trade negotiations, we saw last year that, the global trading landscape had dramatically shifted. And we saw, again, the first slowdown in upwards of 10 years. Now, as the president calls it, we have a big, beautiful monster trade deal on the table, right, with phase one. You look at the dark green bars, those have been the last 4 or 5 years of trade. Again, we export around $150, $175 billion worth of goods and services. The proposed new trade deal has us over the next 2 years exporting upwards of around $400 billion worth of goods and services. Again, having this trade deal underway, it's a good start. It's good news for the markets. It's good news for the U.S. economy and the global economy. 2 things to consider. One, it's going to be really hard for us to hit those targets. That's a huge, huge jump in what we can export. I'm not sure it's really possible, but it'll be worth watching how that changes. The other thing to consider is there's no trade oversight on this deal. It's really a deal between China, the U.S. It's a handshake deal. It may come to fruition, but I'm a little skeptical if we're going to get to these levels. Now, why was that trade deal put into place? We have election this year, and a lot of this may be, political in terms of continuing this growth in the economy and in the market. So it's an interesting chart here. We have the S&P in the 3 months, from August to October, when the S&P rises before an election, you see the incumbent party, whether it's, Democrats or Republicans, the incumbent party has stayed in office 82% of the time. On the flip side, if the S&P declines 3 months before a presidential election, you see the incumbent party winning only 12% of the time. And that can be, an existing president or a new president in that party. So, the future, I don't think it's just based upon those 3 months and how the market's doing, but obviously the overall, how the economy's doing, how the market's doing, is going to have a huge, huge impact, I think, in how this election plays out over the next, 9 to 10 months here. Now, when you take a step back and look at it, does it really matter who wins the election when it comes to the stock market? You go back over time, going back to 1929, the line down the middle, everything to the right is when a presidential term has been in the positive in the stock market. Everything on the left, really 3, maybe 4 times in the last 100 years, is when we've had a negative return in the stock market. Blue is Democratic Party, red is Republican Party. At the end of the day, it probably doesn't matter so much. It's really, having that time in the stock market is the most important. Corporations are going to evolve if there's new laws, changes to the tax code. So we're not as worried whether or not Trump stays in office or a Democratic president comes into play. Last kind of geopolitical macro concern that we want to touch upon is tension in the Middle East. It seems like a lot longer than 2 weeks ago that we had the news with Iran and the tension there. But I went back, wanted to look at the last 3 kind of Middle Eastern conflicts that we've seen and how the stock market played out over that time. So, we go back to Iraq invaded Kuwait in 1990. We have the Persian Gulf War in 1991 and the Iraq War in 2003. In each of 3 of those cases, after 12 months, the market was up 10%, 33%, 28%. So outside of the human toll and the considerations if we were to get into an escalation with Iran, obviously that's a concern. But when it comes to investments, the stock market, if history is any indication, we're not as worried about what the stock market will do. So to summarize, the trade war was a bigger deal than I think we originally thought. The phase 1 trade deal, it's a great start, but again, some of that may be a little political. The 2020 election results shouldn't impact any investment strategy. And lastly, the Middle East uncertainty may create short-term volatility, but long-term, we're not as worried about what the impact will be on the markets. So I want to talk a little bit about our investment philosophy, how we think about the markets, how we think about your portfolio, and what we're doing kind of behind the scenes as we look at these things and make investment decisions. So again, I had a great polling question. I wanted to ask the best performing asset class over the last 20 years. The options were gold, U.S. equities, emerging market equities, and developed international equities. And we were able to run this poll earlier today, and it did work. But I think the biggest surprise here is that on the right-hand side, you see the 20 years total over these last 20 years. And the best performing asset class over the last 20 years, in fact, has been gold. It's been up 421%, which was a little bit of a surprise. Emerging market equities were next, up almost 300%. U.S. equities were up 224%, so performed very well, but not as up as much as gold in emerging markets. And I think what we remember in that middle chart is the last 10 years, 2010 through 2019, where U.S. stocks up 256%. The next closest was emerging markets, only up 48%. I mean, U.S. stocks have been on a tear over this last decade. But you go back to the 10 years before, not so much the case. And I think, what I really want to highlight with this chart and moving forward is, that idea of recency bias and how important maintaining that diversification moving forward can be. So here's some, benefits of broad diversification. So this top chart shows the S&P 500 over the last 50 years, 3-year rolling returns. Over the last 50 years, the S&P has averaged almost 11% return over that time, 10.9%. You can see that black line in the middle is at 10.9. The red bar above, the red bar below is 5% on the upper threshold, 5% on the lower threshold. And you see how that's varied over the last 50 years. And it's moved, pretty dramatically at times, especially through, 2000, before 2090s, 2000 and into 2007. And I want to show you with having a diversified 70% stocks, 30% bonds, globally diversified portfolio. Over those 50 years, the 3-year rolling return, a little bit less, 9.8%, about 1 percentage point per year return. But you see that ride that it's taken. It's much smoother. You don't have the dramatic increases, but you also don't have those dramatic decreases. And that's the benefit of diversification, right? Over that long term, returns are pretty similar, but you have a much smoother ride through those times. Again, just speaking about broad diversification, there's no way to predict the top performers in the stock market. So you look at the left, over the last 25 years, we've seen, the U.S. stocks are up on average per year 7.2%. If you remove just the top 10% performers in the stock market, the returns are only 2.9%. And I can assure you, it is so hard to tell what those top 10% performers are going to be in the market year over year, that if you were to miss 1, 2, 3 of those stocks, it could dramatically, bring down the returns of your investments, your portfolio. This is why we like investing in indexes. This is why we like the ETFs we use, so we don't miss those top performing stocks. You go back, we always talk about how hard it is to consistently outperform the stock market picking stocks. And you look here on the left side, we have the number of funds. This was a study done in 2018. It shows the number of funds that were for large cap stocks in blue, mid cap stocks in orange, and small cap stocks in gray. And as of 9/30/2015, that year to date, that 9-month window, you see how many of those funds were actually outperforming. You go 1 year out past that, those are the funds that are continuing to outperform. And you go out 2 and you go out 3 years, there's almost non-existent how many funds are continuing to outperform. And you see how hard it is to, again, consistently pick stocks that are going to outperform those indices. Can we have a show of hands of how many people recognize who this is? So this was Adam Neumann. He was the founder, CEO of WeWork, which was in the news all the time, latter half of last year. And why is this important? How does it have to do with what we do as investment managers? Well, you look at the valuation last year of WeWork from the so-called experts. So, WeWork was a private company and it was leading to go to an IPO at the end of last year. It wanted to become a public company. Earlier in the year, you had SoftBank, which is a Japanese company that bought into it privately, had that company valued at about $47 billion. Throughout the year, as they were exploring going public, JP Morgan had it valued at about $60 billion, Goldman Sachs about $90 billion, Morgan Stanley at about $100 billion. So these companies were trying to bring it public, sell those shares to individual investors, some of their clients, individual investors just like you, at this valuation. Well, when news of this IPO became public and their filings through the SEC became public, the public quickly realized that this company was probably worth less than $10 billion. And there's a huge, huge lesson here in terms of what we bring to the table in terms of asset managers. The idea of being independent, these are all public companies adhering to their shareholders, and that idea of being a fiduciary, removing conflicts of interest. Those big banks, they were set to profit upwards of $100 million bringing a company like this public. They had a huge, huge incentive to try to raise that value to sell those shares. Having that fiduciary, removing that conflict of interest is huge when it comes to investing, and especially when it comes to investing in a company like this. And speaking of IPOs, we want to look at some of the bigger IPOs from last year and how they did in the market. You have Lyft down 45%. You had Slack for the year down 42%. Uber did a little bit better, was down 28%. Peloton, which made a lot of news towards the end of the year, actually was making money for investors last year, up 10%. Beyond Meat had a very wild ride throughout 2019, up 15%. And the boring old S&P 500, as you know, was up about 31%. One of the reasons why we try to stay away from the hyped stocks, an IPO type market, we really don't see a lot of value many times when it comes to that. Why are IPOs not doing that well? Well, last year, only 20% of IPOs that came to the market actually made money. It's the worst we've seen since going back to 99 and 2000. So again, you want to look at the fundamentals of these companies and what's really at stake when you're making these types of investments. We talk all the time with prospective clients, current clients, in terms of buying in at all-time highs. We've seen markets at all-time highs. Over the last 6 years, I think the market's had all-time highs, about 220 different trading days. We've seen a lot of all-time highs. This was a study that went back about 100 years, and it shows a system of buying at all-time highs essentially stays on even keel with the rest of the market. And why is that? Well, you look back over, in this case, the last 40 years, those big green blocks, those are bull markets. That's when the market is up. That's when the market's doing well. Those, the gray lines or bars are recessions. And you see the little tiny red that's in there. Those are bear markets. When you take a step back, you see a lot more green than that red. And we always try to say, we don't want to plan just for those red days because there's a lot more green there historically. And we feel that's going to continue to happen moving forward. Listening to the bad news bears. This was an example of a slide where, if you were to listen to these folks, these experts are on CNBC, you may see ads on your radio or your TV in terms of advising you to go from stocks to cash or bonds. If you had gone from stocks to bonds over these last 10 years at these different points when these experts had told you to get out of stocks, your returns would have dragged behind the market anywhere from about 25 to 60% behind what the stock market's doing. Again, the last 10 years, we've seen the market up over 300%. We've seen new all-time highs continuously being met. You always have to be careful of what type of news is out there and who you're listening to. I think the last thing I want to leave with is, are stocks a long-term risk? And when you look at stocks on a day-to-day basis, they're very risky. 54% of the time they're up means 46% of the time on a day-to-day basis they're down. That's not much more than a coin flip. On a month-to-month basis, about 63%, yearly 73%, 5-year basis 88%, 10 years stocks are up 95% of the time, 20 years they're up 100% of the time. And the big takeaway here is, one, don't day trade. Obviously that can be problematic. But when you look at stocks, again, on a day-to-day, week-to-week basis, they are a lot more risky than maybe they otherwise would appear. If you go over a longer term, become less and less risky. And that's what we always try to preach to clients, is having that patience, that long-term view of the markets. And so to wrap up, the low-cost index-based approach is really one we believe in, one that we adhere to. Diversification is good over the long term. It's all about time in the market versus timing the market. Don't chase risk, have a defined tolerance, and lastly, maintain that disciplined approach.